Hello, welcome to our monthly performance monitor. My name is Barney Hawkins, Investment Director at True Potential. While much of the city is enjoying a relaxing summer break, the world's principal central banks are hard at work, each meeting to discuss the next move in monetary policy and to decide what action to take in respect of interest rates. The prospect of trade wars is keeping the headline writers employed, but so far the actual effect of the measures introduced has been negligible and, as we've seen in the case of the most recent negotiations between the US and Europe, amicable agreements have been reached with relative ease. In the United States, the most recent reporting season has revealed an economy continuing to surprise on the upside, with the vast majority of corporate results coming in ahead of analysts' expectations. As the tax cuts introduced at the end of last year continue to feed through the economy, we expect these buoyant conditions to be maintained until at least the end of the year. The Federal Reserve is forecast to continue its policy of gradually raising interest rates, but while the economy is growing, this shouldn't present a problem. There's also an expectation that were financial markets to signal their disapproval, the pace of further monetary tightening will be moderated. In Europe, attention has moved on from Italian politics to focus on the very upbeat assessment of the European economy by Mario Draghi, President of the European Central Bank. After a brief correction, European valuations appear relatively attractive and opportunities remain plentiful, particularly for those managers with a value style. With regards to Japan, investors remain positive. The economy is lagging the recovery witnessed elsewhere in the world, which makes it an attractive means of extending the cycle. Earnings potential remains strong and monetary policy remains accommodative, with no sign of interest rates being increased anytime soon. Emerging markets eased back during the first half of the year, impacted by a stronger US dollar. However, markets have now stabilized, and with valuations looking attractive, investors are once again focusing on the growth story represented by these markets. The UK has also undergone a transformation. Despite uncertainty over what Brexit may mean for the UK economy, the UK stock market is seen both as undervalued and, due to its international complexion, representing an attractive means of accessing global growth. The relatively large weightings in the 100 share index to mining and oil companies make it an effective means of gaining commodities exposure, and the average dividend yield of 3.6% should help insulate it from the effect of any increase in interest rates. Sterling at historically low levels also provides fertile ground for international merger and acquisition activity. The recent rise in interest rates to 0.75% generated a lot of headlines, but was widely anticipated, and after a brief dip, the market recovered to the same levels as before the announcement. As central banks around the world contemplate the next move in rates, market volatility is likely to continue, and diversification will remain key. However, from volatility springs opportunity, and for those prepared to look beyond the rhetoric of trade war posturing, there remains much to play for. Thanks for listening, and we'll see you again next month.